If you're planning to retire before starting your CPP, the Canada Pension Plan, that means you'll need to heavily rely on your own investments early on. So there's a critical adjustment you need to make to your portfolio, because without it, you could end up derailing your retirement. So in this video, I'll show you what this adjustment is, how to implement it, and how it can help you draw down your money with a lot more confidence. To illustrate this, let's walk through a real life example of a client of ours. This is Sally. She's a 60-year-old single lady and looking to retire, but she's not planning to take her CPP until age 70. And this is based on some analysis that we've done. So she does have some assets and income in place. So current assets, she has $500,000 in her RRSP, $120,000 in her TFSA. She does have a small defined benefit pension plan. So again, if you've watched a few of our videos, you've seen Sally before. We covered her recently, but I want to break down what matters in this video, which is the cash flow she needs from her investments in the first 10 years of retirement and how to structure that. So when we look at Sally, we've marked it for income needed starting in 2026. So next year, in the year she turns 61. Now, with her RSP, we've done an RSP meltdown. You can see in her government benefits, her Canadian pension plan, or Canada Pension Plan, we delayed that till 70. And we're starting her old age security at 65. But this, of course, means in the first 5 years, there's no income other than drawing down her investments and her small defined benefit pension plan. From age 66 to 70, there's no CPP, just old age security. So when we look at her drawdown of her accounts, you can see in her RRSP, we're pulling out about $36,000 until old age security starts. And then we're actually ramping it up to $45,000 until CPP starts. Now, why that ramp up? Well, because there's more tax credits. And you can see, if we look at her average tax rate, which is what we're always looking at, it still levels out nicely. Even though her income bumps up, her taxable income, her tax paying stays roughly the same. And so these are all things that we look at. The percentage of tax that you're paying, the amount of tax you're paying, obviously that's a big part. Now, what I want to zone in on here is her income needs over the next 5 to 10 years. So over the next 5 years, she needs about $36,000 out of her RRSP, and then it jumps up to the 45. She also needs some money out of her TFSA account. For the purpose of this illustration, let's focus on the RSP for now, because the TFSA or any other account you have will work the same way. Once you know how much money you should be pulling from each account, then you can plan ahead. And how we plan ahead is something called a cash wedge. You can call it whatever you want. I like the cash wedge. What a cash wedge is saying, for whatever the income is that we need or I need for the next 3 to 5 years, I don't want tied into the stock market or any type of investment that has ups and downs. Because when you hit retirement, especially in your go-go years of retirement, you don't want to be delaying travel, expenses, things you want to do another year or two because the markets are down. Why don't we plan ahead for that? And I always get the question like, Adam, how do I approach a down market in retirement? And you're going to have that. There's going to be multiple down markets throughout your retirement. And there's two ways to do it. There's not preparing for it. And this is what I call the Monte Carlo theory, right? A lot of you run Monte Carlo or sequence of return simulation saying, well, if the market drops, here's how sustainable my account is, or here's how I would have to change my income in retirement for that year. Well, instead of changing your income in retirement, especially you only have so many go-go years, why not instead prepare for it? We know the markets are going to drop. We don't know when and how much, but we know they will go down, and we know they'll go up and down. Now, hopefully over time they go up, but in those short-term windows, we want to make sure that you have your cash flow. So in this case, Sally needs $36,000 for the next 3 years out of her RSP. So $108,000 total out of her $500,000 RSP. So she has $500,000, 108 of it we don't want in any high risk investment. So if we take Sally's $500,000 and put $108,000 of it in safe investments. Now, what is a safe investment? This could be a high interest savings account. It could be a ladder GIC. So she could buy a GIC that matures every year for the next 3 years with $36,000. It could be direct bonds. There's many options. And again, whether you have an investment person, whether you're DIY, you need to figure this out on your own. There's many options. There's no right or wrong solution here other than just make sure it doesn't go up or down. It has to be a guaranteed return. And again, if it's a high interest savings, I get it. You're only getting 2.5%, maybe 3%. It's not a big rate of return. I'll get to that here in a second. If we put $108,000 of her RSP aside, that means we put 22% of that account into something that's very safe, that's maybe not generating a lot of interest, return, etc. So a lot of people ask, well, Adam, $108,000 in something that's not earning a lot is a lot of money. But let's actually break it down further. And a lot of you don't kind of do this breakdown. Let's say Sally's looking for a 60-40 mix. And again, I don't typically like to look at asset mixes in finite detail, but let's say she's looking for roughly a 60-40 mix to get her 5% rate of return goal. Her goal is to earn 5% on average after fees in her pocket. So she figures a 60-40, 60% equity, 40% fixed income is a good fit for her. Well, we've already put 22% of her money into fixed income. It's a low interest bearing account that's not tied to the stock market. Now that means we have $392,000 left to invest. Now, she's only 22% fixed income and we need to get to 40% fixed income. So we just have to work down the numbers. Of the 392, we need to put another $92,000 into fixed income to get her up to that $200,000 mark, right? 40% of $500,000 is $200,000. We already have 108, we need another 92,000. So to get 92,000 into fixed income, if we divide that by the $392,000, we come out with about 23%. So here's how that works. 23% of the rest of the money needs to be fixed income. So roughly, let's break it down to a 75-25 mix, meaning that if she put the next 3 years of cash flow aside, safe, going to be there, guaranteed, ready when she needs it, the rest of her money could be in a 75% equity, 25% income split. And that will give her an overall asset balance of 60-40, her overall goal. And hopefully that will give her the rate of return she's looking to get at 5%. And again, your numbers will be different. They'll work different. Your risk tolerance, goal for rate of return, all of that will be different. But this is how you need to break it down. Put the cash wedge aside and then figure out how does everything work backwards from here. And maybe you're taking a lot more. Like as time goes on, Sally needs to put a higher percentage of her RSP aside for future cash flow, meaning that maybe the rate of return expectation will be lower. Maybe the rate of return expectation earlier on could be higher. Again, you can play around with that with your financial planner. But the main thing here is to make sure that $108,000, the next 3 years of income for Sally, is safe, protected, going to come to her no matter what the market's doing. That gives peace of mind in retirement. I've been doing this for 2 decades. We work with retirees. We've seen this play out with our clients. And I can tell you, it relieves a lot of the stress. Back in April, when tariffs hit, markets crashed, the world was uncertain, we got 0 calls from clients. Now, we were proactive kind of leading up to that, but the day it happened, clients knew exactly what was going on. They knew they were not affected. Yes, on paper, some of their portfolio has dropped in value. Now, we have time. We have up to 3 years. We typically have 3 to 5 years of cash flow for our clients. This is what you need to do too, so that when the market drops, when there's uncertainty, when you're not sure if that income is going to be there for you, it will be because you've planned ahead. Stop doing sequence of returns, Monte Carlo simulations. These are all what if, which is great, but it doesn't actually solve the problem. Solving the problem is creating that cash wedge, putting that money aside, and making sure you have 3 to 5 years of future cash flow based on the plan that you put together, ready to go. That brings clarity and comfort into your retirement. Now, the follow-up question is always, okay, Adam, the markets did well this year. Should I draw my fixed income or should I draw my equities that have done really well? Well, that's up to you. I typically would say draw on your equities. If your higher risk investments, market was good and they made 10, 12, 15%, maybe you draw on that and leave that 3 years, just bump it another year. So your GIC maybe comes due, bump it 3 more years, right? If the market drops, you have that cash flow there ready to go. Now, let's say the market drops and you start eating away at your cash wedge. As the market drops, as it comes back up, and when it hits levels that you feel confident with, then start slowly replenishing that cash wedge. Again, it'll deplete over time, get to maybe a 1-year mark, and then come back up. Again, all depends on what the market's doing, but this is the ebbs and flow of it. And this is why you need to sit down with your financial planner. If you're a DIY investor, there's a lot of nuance to this. You need to make sure you're working through this within your plan. And again, it looks different for everyone because everyone's risk tolerance, goals on types of investments you have, ETFs, mutual funds, direct stocks, alternative investments. Trust me, I've seen many portfolios. They're all different. So the way you roll this out will look a little bit different, but the concept stays the same through and through. 3 to 5 years of cash flow, put aside, won't fluctuate with the market, and will be there when you need it. Again, you only have so many years of go-go years in retirement. Don't waste any of them by not planning properly. Hopefully this helps. If you have any questions, leave them below. If you've done the cash wedge, if you've built out a strategy, put that below. Share that with the viewers. We have a great community here. Add in there, make comment, and let's help each other out. We'll see you in the next video.